Hey guys, what's up? Welcome back to another video. In this video, I have a really interesting company to talk about that recently announced their earnings for the first quarter of 2023. And that stock is Eli Lilly. And we can see over the last year, this stock is completely outperforming the market. They're up 42%, while the rest of the market is only up around 4%. So they are really doing well this year. And so in this video, I'm going to look into some of the really interesting news that recently came out surrounding Eli Lilly. I'm going to look into their financial statements and then figure out if this company is currently trading below intrinsic value per share by using a discounted cash flow model. And so right here, this is the interesting article that I was talking about here. It's titled "Why Sanofi, Novo Nordisk, and Eli Lilly slashing insulin prices is good news for investors." Sanofi and Novo Nordisk, for those of you who don't know, are the other two big insulin providers right next to Eli Lilly. And they point that out right here in the first bullet point where they say, Lilly, Sanofi, and Novo Nordisk control 90% of the global insulin market, but despite slashing the prices of their drugs, all three companies' share prices are on the rise. Right here, they point out that the three pharma companies have been accused of hiking prices of insulin so much so that 1 in 5 insulin-dependent diabetics have to actually ration their supplies. And then on top of that, they point out that recently the U.S. government capped the out-of-pocket costs to $35 for Medicare patients. And after that, all three companies decided to slash prices for all other patients too, as well. Then right here, they point out that Novo Nordisk and Eli Lilly recently started developing a new drug called GLP-1, which targets diabetes and weight loss. And that drug is basically projected to be one of their best sellers, capable of generating revenues of more than $50 billion per year potentially. And so obviously the fact that they cut their insulin prices might not be that much of a deterrent on their business if they're able to continue to innovate and launch new drugs that can add to their revenues. In particular, there's a little bit of a timeline here, which I thought was pretty interesting, where they talked about how on March 1st, Eli Lilly announced their insulin price cuts, and then 2 weeks after that, Novo Nordisk announced theirs, and then 2 days after Novo Nordisk did, Sanofi announced their price cuts. So basically, as soon as Eli Lilly did, Novo Nordisk and Sanofi followed right afterwards because they kind of had to, because they had to remain competitive in order to keep up with the price cuts for insulin happening in the market. Right here, this part of the article is titled "Slashing Insulin Prices, an Act of Altruism or a Last Resort." And right here, they point out that the Biden administration recently signed the $750 billion Inflation Reduction Act, which included drug pricing provisions, such as not allowing pharma companies to hike prices by more than the rate of inflation, and they capped out-of-pocket costs for insulin for Medicare Part B enrollees at $35. But obviously, Medicare only applies to people of the age 65 and above. So these big pharma companies like Eli Lilly, Sanofi, and Novo Nordisk didn't really have to cut their prices for the rest of the patients, but they chose to anyway. And so the question is, why did they do that if they weren't obliged to? And this article points out that it's actually not really an act of altruism. It's not really charity. It was a strategic move. And in particular, they point out here that one of their competitors, Viatris, in 2021 won approval for the first interchangeable biosimilar version of insulin named Semglee. And basically, the FDA agreed that for all intents and purposes, Semglee was the equivalent of any insulin product that any of these three big pharma companies could provide. And theoretically, Viatris could substantially undercut these farmers on price, and that would obviously force them to drop their prices anyway in the long run. Viatris also used an interesting strategy here. They opted to launch 2 different versions of their Semglee drug to replace insulin, a branded version and an unbranded version. They were going to price the branded version at a lot more than the unbranded version, a lot more than Sanofi's Lantus, which is $400 per 5-pen package for diabetics. And then they were going to price their unbranded version at 65% cheaper than Sanofi's Lantus. And the reason why they do this is pointed out right in this paragraph here. PBMs, which are pharmacy benefit managers who act as middlemen in drug pricing negotiation between pharmas and insurers, prefer high-priced drugs. And the reason why is because the higher the drug's price, the higher the rebates or discounts on each sale these PBMs can have for the sale to the public. And that ensures that basically PBMs demand these higher rebates as a prerequisite for these pharmas to list their drugs on formulary form whatever that word says. I can't really pronounce it, it's a tongue twister, but you get what I mean. The list of drugs that insurers can reimburse patients for. And obviously, if your drug is not listed on this list, it's not going to be sold as much as the other drugs that are. And so it's very competitive. And right here, they point out another competitive company called Civica, a non-profit drug company that also developed an interchangeable insulin biosimilar product that they intend to sell for $55 per 5-pen box, as opposed to Sanofi's Lantus, $400 per 5-pen box. And so obviously, with the fact that these insulin products haven't really changed their formula over a long period of time, a lot of other formulators are starting to make their own products that are highly competitive and sort of do the exact same thing. And if they can obviously sell those products for way less, then customers are going to flock to those products as opposed to the products that are being sold by these big pharma companies. And that, coupled with the fact that PBMs are constantly putting pressure on these big pharma companies for higher rebates, it's putting a lot of pressure on the profit margins for these big pharma companies, because it keeps on eating away into their profit margins externally and internally. And in particular, in Novo Nordisk's 2022 annual report, they pointed out that the payers, basically the PBMs, are continuing to leverage their size and control to demand higher rebates, particularly in the insulin segment. And as a result, average prices after rebates for the Novo Nordisk portfolio in 2022 in the United States declined. And so to summarize for the article, Sanofi, Novo Nordisk, and Eli Lilly have finally seemed to realize that it was time to move on from an unpopular and outdated method of insulin drug pricing, even if it is only because it is now convenient for them to do so and will actually save them hundreds of millions of dollars per year because of their rebate system. So obviously, as the article pointed out, it might not be an act of altruism. It's actually a strategic move by them to remain competitive and to continue to grow their business. And then lastly, to end off this article, I wanted to touch on these 3 points here. In Eli Lilly's case, sales of their insulin drugs, I don't know how to pronounce this, but you can read it for yourself, accounted for revenues of around $3.8 billion in fiscal year 2022, which is a little less than 16% of all revenues. And so basically, these companies are by no means dependent on their insulin revenues. And as I touched on a little bit earlier in the video, in the article, the two companies, Lilly and Novo Nordisk, are developing a new drug called GLP-1 receptor, which basically is expected to obliterate the peak sales of any of their prior insulin products. So they're still innovating, they're still looking to grow their revenues, and the fact that they have slashed their prices for their insulin products isn't really that big of a deal because, like I said, they're going to continue to innovate, but on top of that, their revenues weren't really that dependent on their insulin revenues to begin with. As we saw, it made up only around 16% of Eli Lilly's revenues. So a very interesting article. It talks a little bit about how the healthcare industry works and how big pharma companies work, and how these 3 big pharma companies, including Eli Lilly here, are going to continue to grow their revenues despite these price cuts. And so right here in this income statement, we're looking at the first quarter of 2022 compared to the first quarter of 2023 results. Revenues during that period declined year over year for the first quarter from $7.8 billion to $6.9 billion. So their revenues are down 11% for the first quarter of 2023. And for net income, that's also decreased year over year from right under $2 billion down to $1.3 billion. So that's a decrease of 29% on their bottom line net income. Then right here on page 7, this is their balance sheet comparing December 31st to March 31st. Total assets are up from $49 billion to $53 billion. And we can see most of their business is financed by liabilities compared to equity. They only have $11.2 billion of equity. And of that, they have around $10.6 billion of retained earnings, which is up from $10 billion. So they do have more cash to distribute to shareholders and reinvest into the business. And then lastly, right here, very interesting, their cash flow statement. We'll get a better look at the value they've been returning back to their shareholders. Right here in their operating cash flow, This has decreased year over year from $2.5 billion to $1.7 billion. But we can see in their financing activities that for their dividends paid, they increased their dividend payout from the first quarter of 2022 to 2023 from $880 million to a little over $1 billion in dividends. But that being said, they ended up slicing the amount of common stock they repurchased in half from $1.5 billion in 2022 to $750 million in 2023. So even though they ended up paying out more in dividends to their shareholders directly, they repurchased less common stock in the first quarter of 2023, which might not be that big of a deal considering the fact that their stock price is still up 50%, not including dividends returned to shareholders. So a lot of value has been returned to shareholders over the last 12 months, and we'll see if they'll be able to continue this momentum moving forward. And so right here, this is a discounted cash flow model to figure out the intrinsic value per share so we can know if Eli Lilly is currently presenting a good buying opportunity. Yahoo Finance is estimating that the company is going to grow at around 24% for the next 5 years compounded annually. They had around $5 billion of free cash flow in their most recent full year. They had a net debt position of around $15 billion after subtracting cash, and then they had shares outstanding of $949 million. And so that means that their estimated intrinsic value per share comes out to be, or sorry, I think I said dollars here, but I meant shares outstanding of 949 million shares. And so that means their intrinsic value per share is $149 per share, which means that at the moment they're not trading below intrinsic value per share. They're trading at around $442 per share. So they're probably trading at around 2 to 3 times their estimated intrinsic value based on these Yahoo Finance estimates. And so right here on the right hand side, I compared them to 2 other American healthcare companies, Pfizer and Merck. We can see that in comparison to those 2, Eli Lilly has the highest gross profit margin, but they have the lowest net profit and return on assets. They also have the highest price to earnings ratio, currently trading at 70 times earnings. And they also pay out what looks to be the largest dividend per share, but something I recently added starting this video is their dividend yield, so we could get an actual better look at which company is actually paying the higher dividend relative to their share price. And we can see that Eli Lilly has a dividend yield of 1.07 compared to Pfizer's 3.14 and Merck's 2.52. So that basically means that for every $100 you invest into Eli Lilly, you're being paid a dividend per year of $1.07. And so obviously compared to other companies, it looks like their dividend is a little bit smaller in that case. So from a financial ratio perspective alone, it looks like they're very competitive, but you probably want to give it to either Pfizer or Merck, mainly just because Pfizer has the lowest PE ratio, the highest dividend, and the highest net and return on asset profit margins. And lastly, I wanted to compare Eli Lilly to the other companies we've looked at in prior videos. We can see from this share price compared to intrinsic value list that Eli Lilly comes in 10th place, trading at around 2.97 times their estimated intrinsic value per share. Current share price, $443 per share. Intrinsic value is estimated to be $149, so they're trading at around 2.97 times that, which puts them in 10th place. Not really that good compared to the other top 10 companies we have here. So far, Google, GE, Chevron, and ConocoPhillips are the only 4 companies on the list that were actually trading below their intrinsic value per share at the time of making the video, as you can see here. And then also in terms of growth rate, we can see that Eli Lilly had a projected growth rate of 24% for the next 5 years. That puts them in 4th place compared to the other top 10 companies we've looked at in the past 30 to 40 videos. ExxonMobil holds the number 1 spot with a 26% projected growth rate. In terms of profitability ratios, we can see Eli Lilly is pretty profitable in comparison to the other companies we've looked at. They come in 3rd place with a 76% gross profit margin and 7th place with a 21% net profit margin. And then lastly, for stock performance over the last 5 years, Eli Lilly is also very competitive with a 439% return over the last 5 years. And keep in mind, this is without including the company's dividend. So if I remember correctly, Tesla and AMD do not pay out a dividend to their shareholders, but Eli Lilly pays out a pretty substantial dividend to their shareholders. And so if you were to include the dividend return as well as the share price return, then this would probably be a lot higher. But this is only the share price return, and even with only that, they're coming in at third place, only losing out to AMD and Tesla's 1,000% return. So based on this, it looks like they're very competitive compared to the other companies we've looked at. They're very competitive in their industry, according to that table as well as from the article that we read. But at the moment, they're currently not trading below intrinsic value per share based on these estimates for the discounted cash flow model. So I'd love to know what you guys think of Eli Lilly. Obviously, this stock is very good. It's a very successful company, and we'll see if it'll be able to continue this momentum in the future. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.